Ladies and gentlemen, thank you for making it through the conference this far. I'm mindful we've thrown a lot at you over 3 days, but I think we're finishing on a high. We're really pleased to have a bank whose share price has actually gone up this year. A lot of banks which have been telling us over the last 3 days their share prices should. So we're in a better place to start. So welcome, Bill Winters, Standard Chartered, fresh off a board meeting, I think. So thank you for squeezing us in this afternoon. So, Bill, we've spent a lot of time on the gas shock in Europe. It's been a Europe-heavy few days. The gas shock, the impending recession, the terrible things that might befall us, and I'm sure that touches your bank in many ways. But actually, I think perhaps your world is a slightly different one. China's had its own unique challenges. I guess somewhere like the Middle East. I know Christmas isn't the biggest thing in the Middle East, but right, kind of it's Christmas, right? Yeah. So what's how would you characterize the macro situation facing Standard Chartered at this point?
Yeah, it's as your question suggests, it's pretty mixed. So yeah, the Middle East is booming for sure, and that's become a really strong performing region for us, having had a couple of tough years. Africa is mixed. Obviously, the food price inflation has had a bigger impact in Africa. Some of those countries are energy importers, some are exporters. The biggest exporter, being Nigeria, has not managed to get out of its own way as it relates to power productions, in large part because of the subsidies that they offer their own population and the dysfunction in the currency markets and elsewhere. So the Africa hasn't been a big beneficiary as it might be in other commodity price cycles. But the importers have been relatively resilient on the power side, and I'm thinking about places like Kenya, which is clearly experiencing stress, but is coping. India is the market that is defying gravity. India is booming. I think it's on the back of structural reforms and genuine increases in locally originated capex, plus good FDI, plus a little bit of the China plus one, or we're just talking about is it China plus one or friendshoring or nearshoring or whatever. But India is benefiting from that, but it's mostly coming endogenously, and that's despite inflation and not very sensitive to food price inflation. In fact, they're self-sufficient in food, but obviously a big energy importer. But India is booming. But you only have to go across the way to Sri Lanka or Bangladesh, who have similar underlying dynamics, but a very, very different outcome. So we obviously took some provisions in Q1 in Sri Lanka. Bangladesh is holding up, but feeling pressure. Pakistan, of course, is feeling tremendous pressure. So it's really a mixed bag. China is obviously the big one. The problem isn't energy prices. I think picking up a bunch of Russian oil at 60 cents on the dollar is probably helpful in that regard. But obviously it's the COVID policies and then the spillover from some of the policy actions, in particular around the housing sector and deleveraging the property sector broadly. We could talk about that if you'd like, but it's really a mixed bag. But as you know, we've got a meaningful business in the U.S. and Europe, or the Americas and Europe, but mostly with companies who are investing back in Asia, Middle East, and Africa. And while the nearshoring or onshoring investments, in particular in the U.S., are becoming very substantial. Parentheses, some of the big investors are TSMC and Samsung and others who one might imagine would be very big clients of ours. So that's actually a good thing. But they're also investing heavily in their Asian businesses outside China. And that also is playing to a relative sweet spot for us. So I'd say it's a mixed bag, but overall, for the time being, it feels okay. But like everybody else, I assume that's sat on the stage, you wake up every morning wondering when the good days are going to end and we're going to get into the real world, because the news flow is pretty awful.
No, I think that's fair. So, shifting to what the bank does as opposed to the economies you're in. So, trade. How do we think about trade? So there's fragmentation, but prices are high. I guess ships are taking longer while you're financing things for longer. So how do we think about your trade business at this point?
I mean, the trade business has been pretty resilient. So obviously, global trade is beginning to slow down on the back of a slowing economy. But the mix is is shifting. It's really only marginal when you look at the actual stats, but it's moving from what had been a big east-west corridor to a, let's call it south-south or east-east. So our intra-Asian trade flows are growing at a nice, healthy pace. The U.S.-China actually hasn't backed off much, but that's a small part of our book in any case. The African trade, Africa is definitely feeling economic pressures, so that particular flow has come off a bit, but we're not too concentrated in any of these corridors. The big one for us is intra-Asia, which is feeling pretty strong.
Thank you. And then the last sort of macro thing, the strong dollar. So you report in dollars and have a sterling share price, which always makes life complicated. But more broadly for the business, quite often people will talk in the markets. A strong dollar means commodity prices go up or emerging markets have a crisis or something. But I mean, strong dollar is a good thing for you? It's a bad thing for you?
Again, it's mixed. So it's the third part of the currency translation obviously is that we have a bunch of our revenues in emerging markets currencies or non-dollars that obviously have suffered from a translation perspective quite a bit, but so have our costs come off. So we're in a typical year we're balanced in terms of our non-dollar income and costs. The mix shift was a little bit unfavorable for us in the first half of the year, and that at least in part because of the particular weakness in sterling. But I think these things will equilibrate over time, and it's not a huge deal in any case. But it did put a little bit of pressure on the earnings in the first part of the year. But look, the big effect of the strong dollar, obviously combined with high inflation, is for those countries that are very exposed in terms of their external debt balances, they're struggling. Sri Lanka has already fallen over. I mentioned the others who are under pressure. And the strong dollar is hurtful for all of those countries. Are we going to have ultimately a problem in Pakistan, Ghana, Zambia, Egypt? I mean, each one is its own case. Most of them have good friends. Pakistan has got a good friend in China and in the Gulf. Egypt has got good friends in the Gulf, and Ghana doesn't have so many good friends, but at least not rich friends. But they are very familiar with working through debt challenges, as is Zambia. And thankfully, at this point, they've all either gotten help or they've brought in the IMF. So there's serious programs going on. With the benefit of hindsight, actually, I wouldn't say hindsight, it was very clear to us at the time, but they weren't taking our advice. Sri Lanka didn't bring in the IMF until it was too late, and that always leads to a much more severe outcome. But yeah, so strong dollar is tough when we think about sovereign debt restructuring or the underlying economic consequences in our markets. We've demonstrated that we've got a pretty good, clean portfolio, and of course we're exposed to each of those countries. But as was the case in Sri Lanka, completely absorbable in terms of our ordinary operating profit flows. Obviously, a bunch of our markets are pegged currencies, and Hong Kong being the biggest, but pegged or de facto pegged in the Gulf, and so no consequence there from the dollar. And China's very interesting. I mean, China's we all know how the currencies moved this year, down to 630, now up to 707, 708. That makes a lot of sense given the underlying structural challenges in the Chinese economy that they are able to weaken the RMB a bit, having had quite a bit of strengthening earlier in the year. And China, of course, is very exposed to its currency level, unlike the U.S., which is not so exposed to the strength of the dollar. Exposed, but not massively. And so I think China's got a little bit of built-in resilience through the currency, and it's hard for anybody to suggest that there's manipulation going on when you look at the underlying interest rate differentials and trade flows. So overall, I think overall it's probably negative for us in terms of the emerging market stresses, but there are some offsets as well.
Thank you. So you mentioned Hong Kong. It's funny, when the renminbi is going up, the Hong Kong dollar is going to collapse, and when the renminbi is going down, the Hong Kong dollar is going to collapse. We're always getting people trying to have a go at the Hong Kong dollar peg.
It's just still $600 billion of reserves that people forget about.
It's that and all sorts of other things. Let's park that and forget that. What I do want to talk about though is Hong Kong, because for this uniquely international place, we've obviously been unable to visit easily for a long time. So you're a diversified group, but it's probably your most important market, really. So I guess thinking forward, if the border opens, bonanza, or it's gradual, and then if the border doesn't open, like how hard does it get?
Well, there's the border with China, and then there's the border with the rest of the world. And the border with the rest of the world is opening, but it's not open. And there's still a lot of disincentives for international travelers to fly into Hong Kong. Even if the quarantine is reduced to zero with a week of restrictions, it's still a bad outcome if you test positive on arrival, as somebody I know very well did recently, like me. And then you find yourself locked up for some period of time. So that's and that is definitely detracting from the attractiveness of Hong Kong in the short term. So is the Hong Kong economy dependent on people like me and you, Alistair, visiting Hong Kong? No, it's not. But do we need to have an open Hong Kong in order to really get the benefit of Hong Kong being the portal to China? Yes, we do. And I think that muscle memory is starting to lapse a little bit. But the signs are encouraging that Hong Kong will open up, if not completely, then materially, in the near term. I mean, all the rhetoric suggests that that's the case. And my Hong Kong colleagues are now traveling out regularly. Ben was here yesterday, and who runs our Asian region. I think it's his fourth time out of Hong Kong in the last 3 months. So everybody's happy to spend a weekend in quarantine on the way back if you have to. The China border is a different matter, and I think would be a bonanza for sure if it really opened up. I don't think we're going to go back to 5 million visitors from the mainland to Hong Kong per year, because the Chinese have discovered that they can find a Prada shop in Chengdu as easily as they can find it in Hong Kong. But there's still I think there's still a sense of a destination in Hong Kong, or I think there will be a sense of a destination. The Macau will also open up, and we all know that triangle was the tourist route. Mm-hmm. Shop in Hong Kong, gamble in Macau, and then go home. And when that opens up, it will be a big fillip for the Hong Kong economy. But the real question, the overwhelmingly large question is Hong Kong going to be a meaningful financial center at all, and then specifically for China? In the China case, I see no risk at all that Hong Kong won't be the gateway into and out of China. And every policy action, whether it's the evolutions of the North-South Wealth Connect, the Stock Connect, Bond Connect, all with Hong Kong having a central place. And it makes sense because Hong Kong has a very clear English law for commercial issues, and an open capital account and a convertible currency. So that's not going to change, and China isn't going to try to match that anytime soon. So I think for China, Hong Kong's position is extremely secure, and that in and of itself is extremely valuable. Now, can Hong Kong reinvigorate to the point where it's a real alternative or a dominant destination vis-a-vis Singapore or Tokyo or even Seoul, which is got its own attractions? Yeah, I think it can. But I think Chinese wealth in particular has become accustomed to diversifying a bit, and probably won't go back to being quite as dominant as Hong Kong was before. So we feel good about Hong Kong in the medium term. We've got to get out of our own way there. I do recall, and those of you that travel a lot to that region will remember just how dire the morale was in Singapore until about 3 months before they opened up. Mm-hmm. And then they opened up, and it was like memories were completely erased immediately. And everybody was fine, and it was never so bad. Anyway, people were separated from their families for 12 or 18 months. It was terrible. And that's obviously the case in Hong Kong as well. I bet that we get at least 80% of that memory clearing when Hong Kong finally does open up.
Thank you. Having mentioned both Hong Kong and Singapore, you've been working hard on digital banks. There, I see you've just launched in Singapore. It's possibly a more auspicious time now that rates are going up to be launching deposit-driven businesses, but could you just talk a little about those?
Yeah, I mean, honestly, I know you're used to people coming in front of groups like this and giving a happy story. We could not be happier with these two digital banks. And at Mox, we're up to 360,000 customers or something. We've been the fastest growing credit card we're the only digital bank that is issuing credit cards or personal loans. Fastest growing credit card for the past 6 months. Still have top-notch App Store ratings, very high NPS scores. So, I mean, it's a really good tech stack and customer offering and all that. And obviously, with interest rates going up, with a big balance now of credit cards outstanding, 75% activated, if I've got the numbers right, And with good loan balances growing, there's obviously a clear path to profitability. We took that tech stack, modified it for the Singapore market. Obviously, I have a different partner. The partner in Singapore is the Fair Price Group, it's the largest grocery store chain, but it's part of the NTUC, which also is a big fund and insurance distributor, part of the Trade Union Congress in Singapore. It's been 2 weeks since we launched. Our new account numbers have wildly exceeded our most optimistic expectations. This is a killer, and it's a killer, and that's good. The tech works. It's the average onboarding time is 2 minutes, 2 minutes and 20 seconds, I think. Unlike Hong Kong, we led with a credit card offering, and we did that because NTUC had an existing partnership with another local bank, which they unwound, but they wanted to offer the 700,000 customers an alternative, which is a trust card. So we've had roughly 50-50 take-up of a current account and a credit card. Once you've opened up one, it's very easy to open up the other. And the average onboarding time for credit cards for an approved line and fundable is 3 minutes and 10 seconds. So it's just best in class and getting outstanding reviews and all that. So I think this is going to be a real success. And obviously the fact that we're leading with a credit product, obviously together with the deposits that are more attractive in this rate environment, means that we'll get to profitability relatively quickly. So if you value it like a digital bank elsewhere in the world, these are very valuable things. If you value it at the price-earnings ratio of Standard Chartered Bank, then you can forget about it. But that's up to you.
It's not up to me. Ask them.
You collectively.
Us collectively, we're all on that. We're all on that. Thank you. Right. So as an analyst, I reserve the right to ask some analyst stuff. So net interest income has been one of the tales, I guess, of your time at Standard Chartered, that rates went to zero and it went down a lot. Rates have started going up and it's going back up a lot. But now, should we think of you as an interest rate sensitive bank?
We are definitely an interest rate sensitive bank, and we've our NIM progression has been from a low of a bit below 120 basis points to we've got it to 140 this year. Rates are going up faster than at the time that we gave the guidance, so we can see overshooting that a bit. And we got it to 160 next year on the assumption that we get a terminal rate in the 4% range, which would again be higher than what we had, what was the case when we gave our guidance last. There's some upside to that as well. So obviously those are material increases, both for this year and then into next year. Equally, obviously, the benefit tapers as rates go up. So if we keep on going and there's another 100 basis points after the 4%, then we will not have the same benefit. It will continue to be positive. You will have noted that our large friend in Hong Kong increased their prime rates today, and one would presume that the rest of the market will react over some period of time to that. And what you'd also note that short-term rates have increased by 150 basis points, and the prime rate went up by 1/8%. So maybe that's not the end of it, or maybe it is. But in any case, that is we're not particularly exposed to the prime rate. Our assets and liabilities are roughly offsetting. So that in and of itself is not a big deal for us. But what's important is that the pass-through rates across the board for us, but also in Hong Kong, and you will have heard this from HSBC earlier, the pass-through rates have been probably slightly better than what we expected. So we passed through a little bit less than we had embedded in our forecast and what we had guided to. And the mix shift of current accounts and time deposits is also pretty much on par with what we would have expected. And that's been the case across the board. So we've obviously got a favorable backdrop, and long may it continue. I know that the forward curve suggests that rates could go into reverse in a couple of years' time. Well, obviously, all watching that and the implications or the suggestion for what that could mean for economic activity, watching that very closely. But for the time being, things are moving in the right direction for us. We're very comfortable with the guidance that we've given. As I just indicated, we might be able to exceed that. And the customer behavior is pretty much in line with what we had expected, which is supportive, obviously, for our underlying view. Thank you.
I'm just going to push you a bit on that because we're all thinking forward, and that curve has kept pointing down at every point, even as the whole thing shifted up. Yeah. So people have got caught on that. But Shape Standard Chartered has been you're very rich in deposits relative to the loan book. 1.4, 1.6. Within that, there's an amount of hedging, in particular on the US dollar book. And whether there's more or less, there's been a lot of discussions over the years, but there's some hedging. So the 1.4 and the 1.6 isn't a full picture. It's a nice progression, 1.2, 1.4, 1.6, but it's not a full picture of what that book would be after all the hedges have matured. So am I right to broadly think that the 1.2, 1.4, 1.6 would there be upward bias to that beyond the end of that period if the rate structure doesn't change?
Yeah, look,
that's a long way out, I know.
No, but roughly half of our hedge book will roll off over the next couple of years, and obviously that means that's then exposed to the market. We obviously could choose to extend those hedges at a point in time, but as the book stands right now, roughly half our hedges will roll off in a couple of years' time. The rest are longer term and longer duration, and we took the decision to step up our hedges earlier in the year, which obviously with the benefit of hindsight, if it was a trading book, that would be a bad trade. But we did that because we are very confident in our ability to deliver on our operational strategy and didn't want to be distracted, or the market to be distracted, by the fluctuations in interest rates to the extent that we could lock in what at the time was already an attractive level relative to our operational progression. So. And it's been good. I mean, I think we as a bank are singularly focused on delivering on the operational targets that we laid out consistently over the past several years, but refreshed and with incremental detail back in February, and that it's quite comforting for me and Andy. I mean, we had our whole management team, actually a superset of our management team together in Singapore for a couple of days last week, focused purely on the operational steps we were going to take to blow through the 10%, rather than just meet the 10% in 2024, if not earlier, to repeat that guidance. And we think we have it within our capacity to do that, but not if we just stand still, and not to be distracted in that venture by all the marginal increases or decreases in interest rates. It's quite helpful to bring that focus.
It's absolutely right. If the margin's 1.2, the bank works not that well. If the margin's 1.6, the bank works a great deal better. So the delta 1.6 to 1.8 is much less than the delta back down to 1.2. I mean, that's how hedging works. To my understanding, I don't actually do this stuff. Nobody would let me know a balance sheet. Just on deposits then. So I think your CASA, well, I've checked it. So your CASA when you joined the bank was about, current savings accounts, about 190 billion. You've grown that to about 310. And that's one of the things you said you'd do. It wasn't the one we talked about the most, but I think you felt that was important for the bank. So just trying to think in that then, there's a bit of a following wind from rates were very low, so why did people bother with time deposits? And then there's the structural shift you put in at the bank. So now that rates are higher and some people are moving to time, what's your experience of how that shifts?
Pretty much what we would have expected. And it was so of course there's going to be a migration when you go from a zero rate environment to a higher rate environment. People will migrate from current accounts to savings accounts or to time deposits. And savings accounts are still very attractive in terms of net interest margin. Time deposits are also attractive, but clearly less so than getting the money for nothing in a current account. And I think we've in our biggest market, Hong Kong, it feels like we have in fact outperformed the market in terms of retaining current accounts. And we ask ourselves the question, why? Like, what have we done to outperform the market? And this is system-wide data, so we're not making it up. It's not like we're doing surveys ourselves or something. And I think the answer is an increasing proportion of customers' discretionary savings that they use for their main investment account have moved into Standard Chartered over this period. So, I mean, there's really only two reasons that people would kind of lazily leave money in a current account at a bank. One is three reasons. One is you don't care. Most people aren't that. Two is it's your main transaction account, and you've got transactions that are coming, and you want to make sure that you've got your liquidity. And three is that it's your main transaction account for investing. And right now, people have withdrawn from the market. We see that very painfully on the wealth management side, which is, it's been a really rough year in wealth management, and we don't see any likelihood that that's going to improve in the short term, given the way equity markets are performing. So there is an abundance of investment and wealth management product-related cash sitting in the accounts, and the fact that we're retaining more of that suggests that we've got a higher market share of people's wealth mind than we did before. And that's quite encouraging for the future when they re-engage with markets. And, of course, we'll see the costs will come down at that point, but it'll be people moving their money into, hopefully, higher profitability wealth management products that we're offering. So the story looks pretty good. But we're certainly going to have migration, and we'll continue to have migration as rates go up out of current accounts into time deposits.
Thank you. So sticking that together, could I venture what might the third quarter look like within that on the revenue side? So the net interest margin, it feels there's some momentum. The loan book has been pretty solid. Wealth management. We've just got to make it. We just got to make it to the end. So, if I put that together, how's the third quarter looking for you?
Yeah, obviously we've got a little while to go. Interest rates have been helpful. I'd say our financial markets results, there's been a lot of volatility in the market. There's been a lot of customer flow, and that obviously plays well in a financial markets business. The flip side is capital markets volumes, in particular in our markets, have continued to be weak. On balance, in what we've defined as financial markets, things feel very solid. Deal activity is slowed down, so both financing and other deal-related activity is slower, but not meaningfully. Trade, as I mentioned, has continued to perform, although global trade is slowing down, and the mortgage business remains strong, and the credit card personal loan business for us is we're coming from a very low base as a practical matter, and we've got lots of engines for growth that are beginning to kick in, mostly through the partnerships that we've set up. It's still very small, but I think in a market where I think purely organically you'd probably have slightly weaker loan growth than has been the case just because of the level of economic activity and higher interest rates. We may be able to defy that trend a little bit, and hopefully over the years defy that trend a lot through our CCBL targeted growth strategy. So overall, the business feels okay.
Thank you. So pretty constructive. Then on the cost side, I mean, there's inflation everywhere. We look in Europe, not so much in Hong Kong, but you've got a broad spread of markets, some of which are experiencing really high inflation. I mean, your ambition is pretty tight on costs, a strong delta between the sort of momentum in revenues, X interest rates, and costs. Can you hold the line?
Yeah, we think so. I mean, it takes real work, I can tell you, to deliver the 2% jaws through the cycle, X interest rates that we have that we've guided to, and the $1.5 billion of gross expense savings with a particular focus on the CPBB business, $500 million in that sector. But we still have plenty of productivity opportunities to extract. We brought in a new head of transformation, technology, and operations towards the end of last year. He came from ING. He's been able to take a good, fresh look at the entire infrastructure, and we're making some pretty material changes in terms of both some of the existing programs that were underway, but also some new programs. We are making those changes both with customer satisfaction and efficiency in mind, but also with productivity in mind. We think that gives us capacity to absorb the bulk of the inflation that's coming at us. And the inflation definitely is there. We all know that. For us, it's probably most acute, and I think probably for everybody, it's most acute in the engineering areas, in particular areas like cybersecurity, data analytics. We have a big technology hub in Bangalore where the inflation is stratospheric and attrition and the market's very high. We have not experienced super high attrition ourselves. I think we're a desirable employer. But the outsourced providers have really experienced some pain. But we added close to 1,000 people in Warsaw and close to 1,000 people in Guangzhou, and that's been a godsend because there's a huge amount of technical talent there, and we don't have the same inflationary pressures. And almost by definition, the people that are taking those jobs in those locations want to be there, whereas in Bangalore they're very happy to pick up sticks and not just go to Pune, but go to New York or London or Singapore as well, if that's where the best bid is. So we've got a lot of levers that we can pull on the productivity side. It's not straightforward, but I'm confident we can deliver that agenda.
Thank you. Right, so impairments. I love this question. Everyone's getting to the end of it. It just says China real estate.
Yeah, heard about that. No, I mean, thankfully there's no satisfaction to anyone as a shareholder, but our exposure is relatively light. But we have exposure, and there's we've indicated around $1 billion to the developers that are at some risk. We took material impairments and provisions, both specific impairments, but also overlay provisions in the first half of the year. The situation's not gotten better. You could debate how much worse it's gotten, but the liquidity is still very tight. The underlying fundamentals of the business have gotten worse. Combination of the financial stress on the developers, meaning they're having trouble completing some of their projects, and the reluctance of buyers to buy in this environment because they see prices falling. So the pressure's there. There's no immediate solution in sight. I think from our perspective, it's perfectly manageable. It's just a question of whether there's something that we have to explain quarter after quarter. But it's not getting better.
Thank you. But broadening that out then, so is that still, so I think at the half year, that was really the area of concern in the book. All the rest of the book, which is the big number, was performing very well. Is that?
That continues to be the case. But even within, like, we had a good first half of the year and absorbed some pretty hefty provisions in China commercial real estate. A high proportion of our at-risk book is now provided. Not the majority, but we could definitely take more losses. But this is very overall credit costs are low, and unless something happens that's surprising to us based on what we see right now, will continue to be low for at least a while longer.
Thank you. So on the capital side, there's been so many moving parts over the years, but you've been able to settle in a reasonably stable range, 13 to 14%, and the bank's been at the top of that range. So could you just talk about how you operate there, whether you can lower that level at some point? Because more profitable banks need less capital, I guess, and kind of investors get that. Rating agencies tend to be slow to reward that, but just thinking about the capital more broadly.
I think we're okay with the rating agencies in this current situation where we've got strong capital, strong liquidity, improving earnings, and the earnings are material, not as high as we've guided to, obviously, but they're okay. So the rating agencies aren't a constraint if we can maintain the rest of the program. Obviously, this is at this particular moment, given the stresses and strains in the market, it's not a good time to reconsider whether we should be at a structurally lower capital level. We obviously let the capital ratio tick up a bit in the second quarter after the first quarter. I think that reflects the fact that we entered a new economic environment. But in this scenario that you painted, where we move past the supply shock and the supply chain disruptions, and we at least have an understanding what the inflation environment is going to look like and how that might work through, and we have an understanding whether, or if so, how deep a recession might be, that would be a natural time for us to look at obviously moving back down towards the bottom end of our capital range, which we demonstrated we're prepared to do in the right set of circumstances. And to your question, could you go below the 13 to 14%? It's not something that we've considered significantly. That 13 to 14% feels like the range that investors, bond investors in particular, expect from a bank in this environment. But as we continue to evolve our business mix and continue to, I think, demonstrate to the market, but also to ourselves, that we have fundamentally changed the way that we buy and hold credit, then the opportunity to reconsider any of that, it will be on the table. But it's not a preoccupation today.
Fair enough. So then the last piece of that picture then really is what do we get? And you set out a 5 billion cash distribution ambition over 3 years at the start of the year. You've started that pretty rapidly, 1.25 billion in buybacks already, and I think dividend accruals. I know they're funny things, dividend, but you're accruing for a bigger dividend. So just talk about capital distributions, and then specifically because I've been asked, how many buybacks do we get a year, right? We've had 2, can we have 3, or really, we've done well, and you're thinking about 2023 at this point.
Yeah, look, obviously we'll see how the third quarter finishes up. We'll also see how the fourth quarter finishes up. Those typically are less capital accretive quarters for all banks, but also for our bank. So the open question, how much the capital ratios would appreciate absent any capital return activities. And for the time being, the business growth looks okay, but we can see the economy slowing. So the RWAs are unlikely to be moving up at a very rapid pace during that period. So we'll see. We'll see how things look, and we'll judge at the time. What we've been clear about, though, is we got a very high hurdle that we set for any inorganic use of capital. So we obviously looked at the Citibank assets. We bid on some of them, but at a price that would have been attractive relative to that other thing, which is to buy back our own shares at a deep discount to book value. And I think that was a clear indication of discipline, and we will maintain that discipline, I hope, forever. We can loosen things up when we're trading at a material premium to book value, but we're obviously a long, long way away from that right now. And we've got a pretty full investment program in terms of organic investment. And our organic investments some of them are semi-organic, right? Making an investment in a company like Advance AI or others. These are small in the overall scheme of things, but they've accumulated up to it. We have a meaningful ventures portfolio right now, and we have a meaningful set of investments and partnerships. You can call that inorganic, but when you go in at book value, that makes it organic. So, and we go into these things at book value. So we're deploying a fair amount of our capital that could otherwise be returned to shareholders at book value to support our business, and we think the returns, what we see, that the returns we're getting on those investments are very good. So we're not shy at all about putting a couple $2 billion of expensible investment, and with another several $100 million of equity type investments into things that are going to generate real growth for us. So that's sort of, call it the good news in terms of what we've done with your money. What we could have returned that at incremental buybacks, at buying back shares at 50 or 60 cents on the dollar. And we'll look at that all the time with that in mind. But we're getting such a nice return on that it's accretive relative to what we could generate on a buyback. And we'll maintain that pace of investment for the foreseeable future. All of which is to say the amount that we earn incrementally is available for shareholder distributions as a practical matter, because the investment program is already pretty full.
Thank you. Last question in the banks track. Done. Bill, thank you very much this afternoon.
My pleasure. Thank you for having me.